Palantir and stock-based compensation. Let's talk about it. Palantir's Q4 earnings recently came out for full year 2022, and we saw the stock-based compensation results. In 2020 full year, we had $1.2 billion of stock-based compensation. In 2021, we had about $778 million of stock-based compensation. And in 2022, we had $564 million of stock-based comp. So we're down 53% from 2 years ago and about 27.5% from 1 year ago with stock-based comp. Now, $564 million just to pay your employees in stock is still a lot of money. I mean, it's over $500 million. However, Palantir needs this. The argument around stock-based compensation has been going on for a couple years, and I still think people don't really understand why it's important. At the end of the day, Palantir is a small $16 billion company, and they're competing against some of the biggest technology companies in the world. Google, over $1 trillion market cap. Amazon, close to $1 trillion market cap, and Microsoft, almost $2 trillion market cap. The deals they're competing for, the contracts they're trying to get, breaking into the enterprise, making sure the government actually pays them and not other companies is not an easy thing to do. And the only thing that differentiates you from the rest of the competition is your personnel. Yes, the technology, but who's making the technology? The people you're paying to work at the company. Stock-based compensation is one of those things that's just necessary for a small company like Palantir that's been public for a couple years. And being down 53% from 2 years ago, I think is a pretty strong improvement given their revenue has also increased dramatically from 2 years ago. Now, here's a clip I want to play from Q4 2021 when Palantir's Alex Carp was talking about what it means to have stock-based compensation, dilution, and GAAP profitability, and what he says might actually surprise you now that Palantir is GAAP profitable. Roll the clip.
From a retail investor perspective, the most negative sentiment I hear regarding Palantir is in regards to the dilution of shares outstanding over the past 12 to 18 months, and primarily in relation to stock-based compensation that's occurred. Other than the remaining shares to be vested that have already been announced, can we expect further dilution and share offerings going forward? Or is it kind of reasonable to assume that the majority of this was from the IPO process and sort of a one-time event for the company?
Okay, so there's like the simple version, which I think, it's like, so there's stock-based comp and there's dilution. The dilution thing, that's a red herring. We're not issuing a lot of new shares. I think it's like in the $9 million range. Yep. And so it would be a little coy of me to say that's like no issue, move on. The thing to understand about Palantir, and then I want to just hit this, is like it's actually not the result of the DPO. It's the result of the fact that we were completely focused on building product. We had no earthly idea we were going to DPO till like right before we did it. And so most companies are, quite frankly, built so that when analysts look at it, the primary customer of most software companies is not the client, it's the software analyst. So it's like we obviously, our primary client are our clients, which doesn't mean, now we're thinking about how do we expose the data in a way that, people on the outside like you and professional analysts and others can look at the data and get a better sense of what's tracking and what's not tracking. But the primary source of a lot of these questions really comes down to, look, we built the company to support the U.S. warfighter primarily, and then dual use it for the glory of humanity, particularly humanity in the West. That was our idea. And because our primary client was not what someone at a hedge fund would think, we didn't actually think of these things from inception. And so now there's a process of normalization. You're going to see that in going forward on these calls. It's like, how do you normalize? How do you provide data that people can look at? How do you provide data that people can understand, that they're used to seeing, while simultaneously staying true to what our mission is? It's like our primary clients are the people we're serving. We're in full line with them, and that's why we survive. Even with the nascent sales force, you can get things to double, which is insane. So then you get to stock-based comp, which is like, okay, so there's two parts of it. Of course, IRI people kind of don't want me to do any kind of forward-looking math, but if you're smart enough to invest in Palantir, you're smart enough to figure out there's essentially there's the how are we comping people, and there will be a normalization that will get us into a range where you would see in a software company within the next 18 months, latest 2 years. But there's essentially, and that's going to take a little time. It is going to happen because it's also very much linked to another question, which is how do you actually run the company so it's profitable someday on a GAAP basis, not stripping out comp, and that is also within eyesight. And those are goals for Palantir because Same reason we have no debt. Same reason we have $2.3 billion on our balance sheet. This is a company built for bad times. Bad times mean strong finances internally, and that means at some point you have to be GAAP profitable. You can't be GAAP profitable if you're diluting people or correctly. Your stock-based comp is totally is not in conformity with other companies. So you're seeing a normalization. This will change. It will change in the relatively near future. It'll be linked to other things that we believe are important for Palantir, like having a company that thrives in bad times. And bad times are very good for Palantir because we build products that are robust, that are built for danger, and then the finances internally are actually built for bad times. And bad times means you have free cash flow. The free cash flow turns into GAAP profit. That means the stock-based comp has to be one that's aligned with our investors. Also because that's basically, it's part of a little bit longer philosophical narrative, but like if software is the only moat, then value and gross shares have to be evaluated in terms of their value. Value only exists if you can actually get a tech moat, call it, maybe it's something besides, and growth only exists if you build a company that is where the technology is strong enough, the business fundamentals are strong enough that the free cash flow actually turns into GAAP profitability, and that's linked to stock-based comp. So this is a priority both because you care, but also, quite frankly, because it is the health of our company, which we care a lot about.
Okay, in that clip, you saw Alex Carp say something incredibly important, which is that there will not be share appreciation on the stock unless there is GAAP profitability. There will not be GAAP profitability unless they reduce the external expenses they have that aren't really related that fundamentally to the business, like stock-based compensation. So Alex Carp, as philosophical as he is, as academic as he is, as high theory talking that he is, he understands that Wall Street will not give the stock appreciation in terms of its share price unless stock-based comp comes down, because stock-based comp is one of the key factors to not being GAAP profitable. Remember in 2021, if Palantir didn't have stock-based compensation, they would have $424 million of net income, or pure profit. The problem is you have the stock-based comp, and obviously you need the stock-based comp in order to even get the deals and the technology that you're creating. So the logical syllogism here is that if we need to get rid of stock-based comp, or at least reduce it dramatically in order to get to GAAP profitability, and we need GAAP profitability in order for the share price to rise, then one would imagine that if we're reducing stock-based comp from 50% from 2 years ago, 28% this year, could we get it down another 30 to 35% in full year 2023? And what could that do for GAAP profitability? At this point, Palantir is proving themselves as a company based on the deals they've been able to establish. CDC, $445 million over 5 years. The UK Ministry of Defense, $91 million. Older deals with BP and Sonadex and Hertz, and it can go on and on and on of all the deals they've been able to get. If they've been able to prove that they have the capacity to land these deals, that the tech is actually working, FoundryCon is a real thing where people are coming and saying that, hey, we are saving money by using this product, stock-based compensation in general should start to go down, because you're just not going to need to pay employees as much as you're paying them, or as much as you pay them in the past, to build some of these fantastic products, because the products are working. They're actually being sold, they're actually getting into the marketplace, and they don't need the massive amount of talent that you needed before just to make them in the first place. Palantir's been doing this for 15 years. They had massive stock-based compensation for the past 5-6 years in order to get to this one moment where it actually works, where the products are actually being sold, where governments and corporations around the world actually need what they're selling, which means you just don't need to pay that many people that much amount of money in order to build the products, because the product's already built. Additionally, employees will not stay at Palantir if they don't see the share price rise. I mean, you're only going to give a company that many years until you realize that your options that are at 15 and the stock price is at 7, I mean, if it doesn't get to 15 in the next couple of years, you're just going to leave, because it's going to expire worthless and you're going to lose faith in the company. So not only does Palantir have a responsibility to shareholders in order to reduce stock-based compensation to generate more GAAP profitability, they know their employees that are getting this massive amount of SBC aren't going to benefit from any of it unless the stock price goes up. There's no point in getting paid in shares if the value of those shares don't go up, which means the fiscal responsibility that was articulated in the Q4 2022 earnings call, I believe, was actually genuine and not just a facade, because they know they can't keep their talent and they can't keep shareholders happy unless they get to GAAP profitability. I know with SPACs, they didn't do the best. They were fiscally irresponsible with SPACs, and a lot of that money went down the drain. And maybe some of these SPACs actually survive. Wejo, one of the companies I'm the most excited about, might actually generate returns for Palantir, but some of those other companies might not. That was an example of being fiscally irresponsible, and companies fail on a lot of these things. Think about all the things Google and Amazon have failed about, that they've lost not even millions, like literally billions of dollars on, but they had to try them in the first place. Palantir is allowed to make some mistakes, but one of those things that shareholders want to see over the next coming year is, can they continue to remain GAAP profitable? And even with all the mistakes they made, they were still able to put up $31 million of net income in Q4. Now, if they're able to grow the way we think they can grow, they're able to reduce their operating expenses, particularly for stock-based compensation, I believe they will continue to have a fully GAAP profitable year. And the biggest reason I feel this is because I don't think they want to go backwards. At the end of the day, they showed they're GAAP profitable. They said they didn't have to be GAAP profitable till 2025. They came 2 years in advance, showing to the market, hey, we were kind of sandbagging that. We think we're actually way more fiscally responsible than we thought we would be. And now it's just a question of if they can prove it. And if they can continue to prove it, I think the market will respect it as the macro changes. If they can't, then they're going to get hit because the market's not going to respect it. But it seems like Alex Carp knows SBC decrease, more GAAP profitability, happy shareholders, happy employees, bigger company, better growth. Let's just see if they can get it done.